Hey everyone, and welcome back. Today's video is going to be part 2 of our stock analysis on the company Alphabet Incorporated, most commonly known as their major business, which is Google. So first of all, if you haven't seen part 1, then some of this might not make any sense. So I highly recommend that you go check out part 1 first. I'll leave it as the first link in the description below, and there'll be a card that pops up on the screen here somewhere that you can click and go watch part 1. But for those who are here and have watched part 1, welcome back. And as I mentioned in the previous analysis, in this analysis in part 2, we are going to be taking a look at the management team, the people running the business on our behalf, and then the intrinsic value part of the section, which is where we answer the question, what is an appropriate price to pay for this business based on our target return? So with that said, if you do enjoy today's video, I would very much appreciate it if you could leave a like on the video and then head down to the comment section and let me know your thoughts on the video down there. Or if you have a question related to investing, then as always, I'll be answering questions down there as the video goes live. But with that said, let's jump into the video. The third component of our 4-step stock analysis process is to take a look at management. And before we jump into what specifically we're looking for in a management team, I think it's important to understand why we have to consider management. Why do we have to look into the management team in a number of different ways? And the main overarching reason or theory behind this is we have a management team in place that are making decisions on our behalf. We have essentially handed off our money to this management team. We've invested in this company. We're owners, but we're not managers. There are people, there's a group of people, a small executive team, and a board of directors that make internal decisions on a day-to-day basis on our behalf. And we need to make sure that not only are they making good decisions, that's obviously the primary thing that we're looking for, right? A management team that has a track record of doing a good job at reinvesting money within the business and managing the financial position of the business. But not only that, but we also need to be able to trust the management team. It's one thing for the management team to be good at their job, but inevitably in any business that you're investing in over the long term, there will be problems that come up. And I want to invest in companies where the CEO is upfront about what is happening. They're honest, they are transparent, and they describe the events that are happening and the ways that they're trying to overcome those problems and those events accurately. There's far too many companies out there with a CEO who thinks it's his job or her job to create a sales pitch to attract new investors. And you can see this all the time. You see this in conference calls, you see this in annual letters, you see this in interviews where the CEO is talking and it just sounds like they're just hyping up the stock. And of course, every CEO is going to hype up the stock, but you can tell the difference between a marketing or a sales pitch CEO and an honest, truthful CEO in those problems, when problems are being faced by the business, because they react very differently in the way that they share information with shareholders. So when it comes to the management team, there's really 3 distinct categories of areas, I guess, in management that I'm looking for that allow us to cover all of those bases, right? Making sure we have a trustworthy management team that's being honest with us and has values aligned with us. They're good at their job. They're actually good at investing within the business and then protecting the financial health of the business. And those 3 categories are management's integrity. So looking at the management and making sure that we trust what they're saying and that their values are aligned with ours. We look at the return on invested capital to assess the ability of the management team to reinvest capital within the business. And then in terms of the financial health, we look at some debt ratios to make sure that the company is being managed with reasonable levels of debt. Hopefully 0 debt. I like to see 0 debt so that there's no risk to me that they can't pay their debts. But in reality, most businesses have debt. So we're looking for companies with reasonable amounts of debt. And of course, this is just going to be a short YouTube video, so I can't go into all of the details about all of the things that I would normally look into in each of these 3 sections, but I can kind of point out 1 or 2 things in each section so that you can kind of get an overview of my analysis here. So in terms of the management's integrity section, one of the things that I really like to see is that the executive team, particularly the CEO, I like to see that they are significant shareholders themselves, that they have been acquiring stock. And if you have a founder that is in power, so the founder, the person who created the company, if they are still the CEO, in most circumstances, they will have significant ownership. And that's why I often find myself investing in companies where the founder is still somewhere on the executive team or on the board of directors. But that's not the case in Google's case. And the second best to that is a management team that has significant ownership, even though they didn't found the company. And the way that I assess this is ownership in relation or compared to the compensation that that management team is earning. So in other words, I like to see that a CEO will benefit more from growing the business over the long term and therefore their portion of ownership rather than just earning their compensation. I want to see that their values are far more aligned in just growing the value of the business rather than satisfying the metrics required to earn all of their bonuses for that particular year. And I think this is one of the areas where Alphabet has fallen down. So Sundar Pichai, which is currently the CEO of not only Alphabet, but also Google, the subsidiary, he holds about $27 million worth of Google stock. And you might think, wow, that's quite a lot of stock, right? And to the average person, that is a lot to have invested in a single business. But if you compare that to the compensation, the salary, and the other kinds of earnings that he's generating from just doing his job, it is tiny. So in 2019, the Google CEO earned $280 million in compensation. Yes, you heard that correctly. He has $27 million in stock, in ownership, but he earned $280 million in 2019, and that is an outrageous amount of money. And you would think that someone who is running Google as a company, if they believed in the company long term, you would think they would be moving a substantial amount of that compensation into just owning stock, right? I'm not even asking him to go out and buy stock with cash. Of that 280 million, he's earning stock. I'm just asking that he keeps a substantial amount of it so that his personal wealth is on the line in regards to Google's business growing or shrinking over the long term. Now, of course, this isn't the only factor to consider. It's not as if I look at that and I think, okay, I will never invest in Google, right? There's other factors to consider, how long he's been working at the company, and I guess there's some more qualitative aspects as well in terms of how he answers questions on the conference calls and whether I think his values align with mine. So there's a number of other sort of things that go involved in that, but looking at the ownership of the management team, the CEO specifically, compared to their compensation, is one of the major factors that influence my decision on whether I believe that my values are aligned with the management teams over the long term. The second part of looking at management is their ability to invest within the business, right? Because as I said, we're basically passing our money off to a management team that is managing these cash flows that Google is producing, and they need to be effective at taking that cash that the business produces and reinvesting it to grow the business and grow the cash flows over time so that they can deliver higher returns to us over time as investors. And the best metric by far to assess their ability to invest effectively within the business is the return on invested capital. Now, I won't talk about the formula in today's video. I have a video dedicated to the return on invested capital. I'll leave that linked as well down in the description below, so go check that out if you're interested. But Google's return on invested capital has been terrific over the past 10 years. You can see that it never dips below 10%, which is typically my minimum benchmark that I like to look for. It's consistently around 20%, and it's not decreasing over time. It's not really increasing over time either, but it is remaining very, very stable over a long period of time, and that is exactly what I like to see. You can also see that the 10-year average ROIC has been 19.3%, and that has improved to 20.8% in 2019. And that's another thing that I look for. Not only am I looking for their ROIC to be consistently above 10%, but I want to see that their short-term ROIC is higher than their 10-year average. I want to see that they're improving over time. And in Google's case, they're not improving substantially. It's pretty similar over time, but it's certainly not dropping off as the business is growing. And then, of course, the final section of management is to look at the debt management of the company, making sure they're in good financial health and that the management team isn't blowing up the business with a bunch of debt and doing crazy share repurchases or making speculative investments or anything like that. I just want to see that the company has low levels of debt and lots of cash around in the event that something slows down or prohibits the business from generating cash flow. There's really two key ratios that I look at here. The first is the current ratio, and that's a comparison of short-term assets and short-term liabilities, debts that are due in the next 12 months. So it's kind of a short-term liquidity, financial health measure. And then the other measure that I look at is the debt to equity ratio. And that's more of an overall view, a comparison in terms of a couple of things, really. Firstly, how easily the business could pay off all of their liabilities if they sold all of their assets, if the business needed to be liquidated. And then also it draws a comparison between where the funding for assets is coming from. Is it coming mostly from equity, from reinvested cash flows, or is it coming mostly from debts and other liabilities? So the current ratio for Google is currently 3.4, which is outstanding. I like to see 2.0 or above. So 3.4 is just ridiculously good. And even in most cases, I will accept a current ratio that's above 1.5 or even above 1. So 3.4 is fantastic. And then in terms of the debt to equity ratio, this came in at 0.3. Now, this one you want to see really, really low. Low is good in this circumstance. And in the best cases, I like to see this below 0.5. But below 0.5 rarely happens. It's rare that a business has a debt to equity ratio that's below 0.5. So typically I'm looking for this to be below 1. But in Google's case, it's 0.3, which is just outstanding. And all of this is to say that Google's financial position is probably one of, if not the best, financial position, financial health out of any public business that I've ever seen. They have basically no debt, and they have a ton of cash around, which means if an opportunity to make a significant investment in a new industry, an existing industry, or just to make an acquisition of another business, if any of those opportunities arise, or maybe the stock falls substantially and they can repurchase stock, if any of those things happen, and when those things do happen, they have tons of money and they're able to capitalize on it. And the other thing is that if they're in an environment where the business is struggling, which kind of looks like they won't be in that kind of environment ever, considering we're in the middle of a pandemic and they're still thriving. But if they were ever in that situation, they're not going to be worrying about paying their debts. They're going to be looking for other businesses that are struggling so that they can absorb those businesses. The greatest businesses have really good financial health so that when everything hits the fan, shit hits the fan, and most businesses are suffering, the good businesses have a ton of cash around and they can just pick up the crumbs of the good businesses that had poor balance sheets, and they can absorb those good parts of the business and grow their market share over time. So that's the management section. And as I said, I've got videos dedicated to all of those areas of management and any other part of analysis that I've spoken about in today's video or even in part 1. I'll leave a bunch of them linked down in the description below. But if you're looking for a structured, ordered bunch of videos that go through the process, then just go over to my channel, click on playlists, and then watch the 4-step stock analysis playlist. That has all of the videos that include direct education in terms of this analysis process. So with that said, we can jump into the final section, which is intrinsic valuation. And this is where we answer the question, what is an appropriate price to pay? And the way that we determine what is an appropriate price to pay is to estimate the future cash flows of the business. Because over the long term, the cash that is delivered to us in terms of the stock price going up and us being able to sell that investment at a higher price, and the dividends, so the combination of those two, is best represented by a cash figure that I call cash flow for owners. And Warren Buffett calls it owner's earnings. Actually, I think Warren Buffett has a slightly different way of calculating it, but both aim to achieve the same thing, which is come up with a figure that represents the cash that is then delivered to us in the form of either dividends or the business becoming more valuable and the share price going up with that. So what I do in this section is I use my stock analysis spreadsheet, which is completely free. By the way, if you haven't downloaded that spreadsheet, it'll make your life a lot easier when doing this kind of analysis. I'll leave it linked down in the description below. Lots of links for you to click on after this video today. But go download that spreadsheet, and that has a discounted cash flow calculator in it, which allows us to estimate some growth rates for their cash flows in the future. And then the calculator will come up with an estimate of the total amount of cash that we can reasonably expect to get out of that business and then we can figure out what price to pay. Because ultimately, what price we're willing to pay today for a stock entirely depends on what we're going to get back from that stock over its remaining life, or at least over the next 10 years. So as I said, I'm not going to be doing any calculations or tutorials in this video. I have other videos for that, so go check them out. And this video would go on for way too long if that was it's already gone on for way too long. It's already 2 videos, okay? I can't make this 3 videos. Someone will kill me if I do another cliffhanger at the end of this video. But I will show you some models that I came up with. And the first thing that I would say is that you cannot just copy these models and assume that they are accurate, right? You need to come up with your own analysis if you're going to be investing in any company. These are models that I did at some point in the past. My opinion may have changed since I did these models in the past. They may change in the future. Something might come out about Google that changes my opinion about how I think the cash flows can grow in the future. So you can't just look at these growth rates and go, yeah, I'm just going to copy that. You need to do your own analysis. And if you can't do your own analysis, then don't invest in Google. Try and find another individual business where you can. Or if you don't want to do analysis at all, just buy into the market, buy an index fund. But as you can see, I've got 5 different models, and I like to do a range of potential growth rates so that I get a range at which I think intrinsic value sits, a range in which I would be comfortable starting to buy this stock. And you can see that my growth rates range from 6% all the way up to 16% per year compounded growth for the next 10 years. And then I am using a discount rate of 22%. And the reason why I'm using a discount rate of 22% is because in reality, I'm targeting a 15% long-term return, but I want a significant margin of safety for errors in my valuation. So I always target a return that is a little bit higher than what return I ultimately want to make over the long term. And that gives me that margin of safety for errors. So I'm targeting a 22% return. And when I do target a 22% return, you can see that the buy price per share, so the range at which I would be comfortable investing in this company and expect that I can make a 15% or more return, would be somewhere between $340 per share and about $580 per share. Now, the first thing that you'll notice is that that range is way below where the current stock price is. And that's okay, right? Whenever we're looking at companies that are the caliber of Google, really, really solid businesses, fantastic financial position, really good returns on invested capital, clearly has some distinct advantages, almost has a monopoly in some markets, you could argue. When you have a business like that and everything is going well for it, its stock price is going to reflect that, right? You're not going to be able to just buy that stock at any point and make a 22% return or make a 15% return. When everything is going well for businesses like that, their prices get bid up so that the long-term return you're likely to make if you invested right now is probably going to be pretty average, pretty moderate, right? You might make a 5 to 10% return if you're buying Google at this point. And that, of course, is assuming that they grow within the range that I estimated, but it's entirely possible that they grow faster than that. And then, you could buy the stock today and you could make your 15% return. But I like to be conservative. I like to have reasonable growth rates that I think are highly likely that the business will achieve. And then I just wait. I just wait for a problem to happen with one of the businesses on my watch list. And Google may never get cheap enough for me to invest in it. And that's okay, because every now and then I have my watch list of 10 or 15 businesses. And every now and then, 1 or 2 of those businesses will go through a short-term problem. Their stock price will come down substantially, and I'm going to invest heavily into them. And that's what I've been doing over the past few years. I've been able to generate significant returns doing that. And as I've said throughout this entire video, if you want to learn more about that process, then check out the 4-step stock analysis playlist on my YouTube channel. I'll leave it linked down in the description below. So I hope you guys enjoyed today's analysis. And if you want to see more analyses like this, where I break down a real company that I've analyzed, and then you can kind of use that as a case study to see how I structure my analysis, then make sure you let me know down in the comment section below. And really the best way that you can show me that you want more content like this is to leave a like, leave a comment, and then subscribe and hit notifications if you haven't already. But with all of that said, I'll see you guys down in the comment section answering some comments and questions as always. And I hope you guys have a great day, and I'll see you in the next video.